Welcome to the deep dive video update. This is a video that I do over the weekend where I go back and I look over the charts, mainly for the daily videos, and I pick out those charts that I really either didn't use or I stopped using at some point during the week. And then I put them together into this video because sometimes we can get some context, we can get some insight or clues as to what's happening by looking at these charts. And there are additional charts that I show that are unique just to this particular video, and it's more for informational purposes. This is being prepared for Monday, June 16th. Before diving into today's video, if you find it helpful, consider a 30-day free trial to the SPX investing program. This trial lets you explore my unique approach to market analysis. Full-length daily and weekly videos are available on a delayed basis after the market closes. For immediate access, become a member by clicking on the link below. Okay, this is an informational chart, and it gives us a longer-term look at the VIX. Now, the VIX is on this chart, but it's turned invisible. Over top of that is what you see, which is the 50-period exponential moving average of the VIX. And that gives us a general idea of what is the overall range of the VIX. And we're still below 20. We've been rolling over a little bit as we've been coming up out of the April lows. So in a bigger picture sense, we're still looking more positive. When the market is really under pressure, the VIX tends to go up into a higher range. When we're going up with the market, the VIX drops down into a lower range. And even though after Friday's session, we're above 20 with the VIX on the daily side, we haven't crossed above it here longer term. So that's another clue that can suggest that, at least for right now, the decline that we saw in Friday's session may be just a pullback. Now, we'll be watching that every day throughout the week to see if that morphs into something that's a little bit more severe. Also, we look at the VIX and then the correlation of the VIX to the S&P 500. Coming up a little bit with the most recent calculation here, but we only really pay attention to this if we go above the dash line, and we're far away from that. So we're not getting any additional insight from this chart. Then we look at the VIX, and then there's like an indicator of the VIX called the volatility of the VIX, or VVIX, and do a ratio between the two. And in a general sense, when this ratio is going up, that's typically meaning that stocks are going down. We still continue to come down with this overall ratio as the market has been switching back and looking more positive. Now, we're getting close with this one. This is called the SKEW Index, and it's calculated in a different way than the VIX, but it still tries to measure volatility and sentiment in the market. And the VIX uses at-the-money options, so options that are at current prices for the S&P to be calculated, which changes all the time. This uses out-of-the-money options, either above current price or below current price, to give us an idea of how this is calculated. Well, we really only pay attention to this if it goes up into the red area. We're close, but we're not quite there yet. So I'll be keeping an eye on this. If we do go up into the red area, the market is expecting some kind of a big move. Now, we don't know just by looking at this chart, because there are times when you can see it marked along the way here. Sometimes that marked the top, sometimes that marked the bottom, sometimes it was just a continuation of what was already happening with the S&P. But we use other charts to give this chart some context, so we'll be keeping an eye on that. Then we look at the Ulcer Index, which is another sentiment gauge, still below the moving average, and the moving average is starting to decline. That means that there's not a lot of fear as measured by this indicator. Then we look at the volatility of stocks and do a ratio with the volatility of bonds. In a general sense, even though we're spiking back up because Friday was a down day, the moving average, the red line, that's what I pay most attention to, and this is still continuing to decline, and that is more positive. And we look at a ratio between large caps and small caps, not really seeing anything too substantial here. We've been just chopping for most of 2025. Then, just for informational purposes, to give you an idea of how far we've climbed since the October 2022 lows, Even with being down slightly in this previous week, we're still up 71.04% from the October 2022 low. We're up 45.65% from the October 2023 low. And then we had that low, which looks like it could be a low, back on April 7th. We're still up 23.62% from that low as the market has been improving. We are above the 200 period moving average. We're 2.93% above the moving average. That's helping the long-term trend to stay positive. We look at a bunch of anchored moving averages, and these are usually plotted at either a low or a high. We're above all of the anchored moving averages. So unless we start to decline, and we're seeing some pretty good support here, because sometimes these anchored moving averages, if we start coming down, they may at least provide some kind of support or a slowing down of things. But since we're above all of these moving averages, there's been no need to show this chart in the daily videos. We look at the S&P on top, and then here is the cumulative advanced decline line, just kind of chopping around right now. That's why I haven't been showing it kind of off and on this week in the daily videos, because we're not really seeing all that much. This is based on price. We're seeing a little bit more movement here based on volume. Now, other than the decline that we saw on Friday, we've been seeing volume coming out and actually setting a new all-time high with this chart. That's positive. And sometimes volumes can lead price, especially if we're going up. We're not really seeing it reflected in price up here, but we are seeing it reflected based on volume, even though we did decline in Friday's session. Then we look at a regular NYSE advanced decline line, which really, it's been setting recent all-time highs. That's positive, but we did pull back in Friday's session, and lately we've been crossing back above with the blue line over the red line, which is a golden cross, and that's signaling an uptrend. Then the cumulative advanced decline line for the NYSE, it did come up and set a recent all-time high here, and then it pulled back in Friday's session. And then another NYSE advanced decline line, also just coming off of setting a recent all-time high. This advanced decline line is calculated slightly differently. That's why I show both of them quite often. Then we just break this out based on common stock, coming down a little bit, but not setting a new high, at least yet, above this previous high set back in May or April here. So we're just kind of chopping along sideways, where we did just set a new all-time high based on volume, but then we pulled back like everything else in Friday's session. Now we look at some ratios. The top ratio is the discretionary sector, which is more growth-oriented, versus staples, which is more defensive. And this is a weighted ratio, meaning the bigger stocks, Amazon and Tesla, they have more of an impact on how this particular sector ETF is calculated. We've been pretty much just going sideways with this ratio, not really turning positive, but not really turning negative. Then we use the equal weighted version of a discretionary to staples ratio. This is actually coming down a little bit, showing a little bit more weakness recently after it had been improving. And we look at a tech growth to utilities considered value area, had been improving, but rolling over on Friday. Biotech, which is growth to healthcare, also generally improving, but pulling back recently. And then hotels, which are discretionary, versus utilities, which are more value or something that you have to have. That's been seeing a little bit. That's been seeing a little bit more weakness here lately. We just want to keep an eye on these ratios. Then we look at what are called bellwether stocks or industries. These are the real driving forces of the U.S. economy, and we just want to look and see how they're doing. Where the semiconductors had been improving, but pulling back, home builders still not looking all that good. Interest rates are higher, and even though they've been coming down, it's not really helping the home builders all that much. Transportation had been doing better, but now pulling back. Retail doing better, but pulling back. Regional banks pretty much going sideways, but now coming back into the lower end of the range that they've been in. We keep an eye on a large cap growth ETF. This is still looking okay, and even the chart pattern. This looks very similar to the S&P and the NASDAQ 100 and other indexes that we follow, where for the most part we're seeing a series of higher highs and higher lows, and that's good. And even with the decline on Friday, we still haven't broken this basic pattern of higher lows yet. Now, if we see more follow through to the downside, that's going to change. But for right now, we're looking okay with this ETF and we're above all the plotted moving averages. Then we look at value and do a ratio with tech, which is growth. And this ratio still continues to go down, and that's positive for the market. If this ratio is going up, like we saw going into late March into April, that's seen as more negative. This coming down is more positive, and that's still continuing for the present time. We look at momentum stocks, which tend to hold up better when the market is going down. This started to go down as the S&P was going up, and now we're just kind of chopping along sideways. So we'll just keep an eye on this. We like to see good positive momentum compared to the S&P, and typically this will go up when the S&P is going up. They've been kind of diverging from each other over the last few months. Then technical alerts are put out by stockcharts.com. We start at the bottom. Those were the alerts generated on Monday, and things were pretty quiet throughout the week. We're not trending in the short and even intermediate term on the daily side. And we're just kind of going up and down. There's not a lot of conviction. We still tend to be below average with volume pretty much every day over the last number of weeks. So we saw some positive and negative signs. Now, things turned more negative on Friday because of the escalation of the geopolitical events between Israel and Iran. And so we saw stocks taking a hit. We saw the more defensive areas where people go when there's trouble. Those actually showed some improvement with oil. It's up into the mid 70s. It's not only above 70, it's like at 73. And then gold. That's where another place that investors go to when they see or fear some kind of geopolitical unrest. So a lot of the things that happened on Friday were negative, with both the Nasdaq and the S&P crossing below certain levels, but then the more insane areas, the things that people flock to, called a flight to safety, those actually saw some improvement. Then we look at 6 different indexes and score them from 0 to 100. The better the index, the higher the score will be. And we're still coming in first place with the Qs, even though they're dropping off recently. This is not a great score in and of itself at 70.5, but it's the best looking index from a technical analysis perspective, at least for right now. Coming in second place is the NASDAQ Composite, with it, and it's kind of a distant second at 58.4. It's been coming down as well. Then in third place, which is a combination of growth and value, is the S&P 500 at 55.2. Then we start to really drop down here. The Dow, now Boeing, which suffered the 787 crash this week, has been having some problems. There's some components in the Dow that have been struggling, and that's really causing the Dow to lose some of its score. It was able to get above its 200-day moving average earlier in the week, but then on Friday it dropped down below its 200-day moving average, and now it's coming in with a score of 18.7. Then we start to go down to single digits. The mid caps just really struggling right now, not above their 200-day moving average, and even below that are the small caps. Now, a week ago, small caps had a pretty good week, and we actually got up into double digits. They gave pretty much all of that back on a scoring basis here, coming in last place at 7.2. Mastering the stock market is challenging and can take decades to achieve. Most beginner traders and investors feel overwhelmed and often fail. Stay ahead with the SPX investing program. Members gain access to the full program. Other options include immediate access to videos as they become available. Alternatively, the daily and weekly newsletters may be helpful. Click on the link below to find out what's best for you. A short-term rainbow, these are simple moving averages, starting with a 10-period and going all the way up to a 50-period moving average. And even with the pullback, we're still above the majority of the rainbow. So the short-term trend is still holding together for right now. And for the most part, all of these lines continue to go up, and that's positive. We keep an eye on the 20-period simple and exponential moving averages. And even with the decline, we haven't even come down to the 20-period moving average yet. If we see more weakness, we'll be watching this area for possible support. And we look at a short-term advanced decline ratio. Now, I show a chart every day in the daily videos, which deals with price. This chart also deals with volume. And even though it's pulling down a little bit, we're a little bit negative here based on price. We're declining, but we're still above zero here based on volume. So that is still looking a little more positive. Then another intermediate term rainbow going from 50 periods up to 100 periods. We're coming down here, but we're well above all the lines in the rainbow, and so the lines still continue to turn up. We keep an eye on the 50 period moving average, which is the intermediate term trend, still going up with the exponential version of the moving average. It moves faster because it's where the simple moving average is, it treats all 50 periods the same. The exponential moving average weights it closer to current prices, and that's why it has a tendency to go quicker on the chart here. So this is still showing that the intermediate term trend is looking pretty good. Then a little bit longer term to somewhat, it's like long intermediate term or short long term. So yeah, there you go with that. We are still looking good here. Now, one thing to note is we came up to this R1 pivot level, and that was the high that was set on Wednesday. We could not get above that, and we've been declining ever since. And these pivot points are really handy because they're on the chart before we even get there based on price or time. And so that can be a really useful tool. But just looking at the 100 period moving averages, they're still looking good. And we can see here the red line, which is the exponential version, it's starting to cross above the green line, which is the simple version. And that would just suggest that things are looking even better. Then I was showing this chart every day except for Friday in the past week. This is called the boom indicator, and it measures how far away is price from a 20 period moving average. And if we get too far away, price has a tendency to snap back to the moving average. It acts like a rubber band or a magnet. We were also getting far away from the 50 period moving average, and now we're dropping down below this extreme reading. And then on the bottom, when we're above zero, that's taken as more positive. How far away are we from the 200 period moving average? And since we're no longer extreme, I didn't use that in Monday's video, and I switched the chart over to this particular video. Bollinger Bands, not seeing any extreme readings. There's a whole different way that you can use Bollinger Bands. This is just one implementation here. And you can see the bands themselves are getting kind of close to each other. And a lot of times that means the volatility is really starting to shrink, and then we might see an explosive move either to the upside or downside. Not really seeing much of that yet. But how this chart is used, it's called the %B indicator. And it just measures, are we above or below the upper or lower Bollinger Band? And we're not. So there's no extreme reading in this chart. Now, even though we're declining, we're still above the midpoint. And when we're above the midpoint, which is the dashed line up here, that is more positive. Then just on a percentage basis, I measure from the low set back in 2023 and then to Friday's close. We do have some declines here that are measured on a percentage basis. Again, this is more just for information, and I have to eyeball these to kind of get an idea of where we're at, so the percentages are far from exact. Then we use the Connors RSI, very similar to the other oscillators. We look for extreme positive or negative readings. With the down day, we're dropping below the midpoint. And on a daily basis, this really moves all over the place. We don't see extreme readings all that often, and we're not seeing one right now. Now, earlier in the week, I did show this in the daily video because we were going above the black line here with the CMB composite. It was starting to get extreme. Since then, it's worked its way back down and is no longer extreme. Standard deviation, how fast are we moving? And we've been not trending. And even though we have an upward bias here with price movement, we're not seeing all that much conviction behind price movement right now. And so the standard deviation, which measures speed, whether we're going up or down quickly, has really dropped off. We keep an eye on the S&P 100 and the S&P 500 together, not really seeing any real negative divergence right now. In a more positive environment, we would see the S&P 100 outperforming the S&P 500 because they're the bigger stocks. And that's what we see on a ratio basis on other charts, but we're not really seeing any real discrepancy here just when we look at the price charts. And then earlier in the week, we did have a new X drawn in here when we hit the 6,050 level. That was on Wednesday. That's also when we hit that pivot point, and then we've been coming down since then. We didn't generate anything on Thursday or Friday, so that's why I have it in this chart. Now, this is still pretty positive overall. We have blue lines coming up here showing uptrends. We broke below this red line, which was showing the downtrend. And back on June 6th, the ascending triple top breakout was generated by the point and figure chart. And point and figure charts just take price into account. When we go up or down by a certain amount, if we go up, an X is drawn. If we go down, an O is drawn. And it could take an hour or it could take a year. It doesn't really take time into the overall equation here. But for the most part, this chart is still looking positive. Mass index coming back up, but we only pay attention to this chart when it's around the red dashed line or the blue line and it's far away. Then longer term rainbow, even though we are declining, at least in Friday's session, we're still well above all of the lines in the rainbow. And these moving averages go from 50 periods up to 250 periods. So the long-term trend is still showing some improvement. Then I talk about this in the daily videos. This is a long-term trend measurement. This is called the special K, like the cereal. Now we're still positive on the weekly chart, and we were really improving here on the daily chart, but then we're starting to roll over again, and we're getting a little further away from the red line. When we cross above the red line, that's when we turn over to positive. And I don't show this chart because we don't get very many signals with this particular chart. So I just keep an eye on it and then show it in this video. Then there's a weekly chart of the S&P on top and a weekly chart of the German DAX. The relationship is starting to get stronger again. Now, German stocks, that's the biggest market in the EU. They're just coming off of recent all-time highs, but pulling back as the S&P's actually been improving. And that's why we're seeing the longer-term correlations start to get stronger again. Support and resistance, this is the Ichimoku cloud, where if we're above the cloud, that's positive. We see a green cloud off into the future, that's positive. And really all these are just moving averages that are plotted on current price, and then the chart software shifts it forward. And this can be kind of a handy support or resistance level. Well, we're well above the clouds. And then we look at the green line, that is the short term, and that's coming up even though it declined on Friday. And then more intermediate term is the blue line, and we're still doing okay. We're going up with that. And then longer term is the red line, and the blue line is above the red line, and that's positive. So even with the decline in Friday's session, this chart is still looking positive. Then we look at the VIXen, which is the VIX for the NASDAQ 100. It's starting to go back up too, as the NASDAQ 100 was down on Friday. We look at the S&P on top, and then a growth to value ratio, the Qs, which is growth, diamonds, which are the ETF. It is the ETF for the Dow, which is considered to be more value. And we're seeing a little bit of a lessening here. We're getting back down almost into the neutral area when we look at the top chart and then compare it to the middle chart ratio here. The Dow and the transports, when the red line's below the black line, that means the transports are underperforming, and they've continued to struggle. So as the Dow is also struggling, but it's doing better than the transports. The bank ETF, it was looking more positive right now. We actually got back above the 200-day moving average. Well, in Thursday and Friday session, we dropped back down below the 200-day moving average. And we're keeping a close eye on the financial sector to the S&P, which is showing some weakness. And I've been showing that in the daily videos, and I also went through it in the intermarket analysis video. This is a different variation where we look at regional banks, which are smaller, and we compare it to how is the financial sector doing. Not really much of a change here. Still in an overall downtrend. We would like to see this do better and eventually get back to the point where we see a golden cross, but we've got quite a bit of work to do before that's going to happen. Then, as I say every week, this is an apples to oranges type of comparison. We look at the S&P 500, which is the bar chart, and then the red line is the NYSE advanced decline line. Now, the S&P has its own advanced decline line, and that's what I showed earlier on, and I study that pretty heavily. This is looking at the S&P, which is the benchmark of the U.S. stock market, and then comparing it to a broader measure of the advanced decline line. Seeing a little bit more of weakness across the broader market than we are with the S&P. Typically, when these lines are more on top of each other, even though they're on different scales, that just means the broad market is participating with what the S&P is doing. If we see more weakness with the red line going down faster than the S&P itself, that might mean that the broader market is turning more negative and seeing more weakness. Okay, and we want to keep an eye on retail because it's such a huge part of the overall economy. I'll probably show this chart in the upcoming week because we're going to get retail sales reported. But when we do a comparison of retail to the S&P, it's still underperforming, and it has been now for quite some time, going back to 2022. Even when the S&P was going back up, retail was not. But then we look at retail all by itself, and it's coming back down to its 200-day moving average. So it's seeing some weakness right now. And we are dropping back down a little bit below the midpoint here with the RSI based on 14 periods. Then we look at a ratio between energy and the 10-year bond ratio. I mean, pretty much since the beginning of 2023, this ratio has just been going sideways. So we're not really seeing any real concern. For a while, it's been coming back down. It could go back up, but it's still pretty much range bound. Not like what we saw back in 2021 going into 2022 when energy was really outperforming interest rates at that point. That was giving us some warning signs. But right now, we're not really getting much from this chart. And we keep another eye on gold to the S&P. We came right up to this descending trend line here, and we've been underneath it ever since. That just means that the S&P is still holding up when compared to gold. The U.S. versus international stocks, this has been going down. Now, lately, if you go back about midway through April when we started to bounce up out of the low, really this has been going more or less sideways. So we're not seeing a big change in the overall ratio, but we're not seeing it weaken like we were from the early part of February going into the April lows. Then emerging markets still continue to underperform developed markets. That's still continuing there. Then we have the 10-year yield in the U.S., and we should subtract the German 10-year yield. And since U.S. rates are higher, that's why we have a line above the red line here, above 0. And then we look at, actually, it's just a little bit above 1 right here. And then we look at the U.S. dollar index, because sometimes, typically, what you'll see is there's a pretty high correlation between the top study and the middle study. And then it's kind of wearing down. We're getting back more to neutral now as there's been a general shift with things. We do keep an eye on the German DAX, which is coming off of setting a recent all-time high. It's probably the strongest index on the globe right now, but that could always change. U.S. stocks could come back in and take a leadership role, or if this geopolitical situation still continues to escalate, it could impact all stocks across the globe as well. And we have been seeing an improvement with the ratio. When we look at U.S. stocks versus German stocks, we've been coming up with this overall ratio, but we had been declining going back right to the beginning of 2025. This is when this ratio was going down, meaning German stocks were outperforming, and we started to go up, then we come back down, and we're just kind of range bound currently. We keep an eye on the QQQs, which is the ETF for the NASDAQ 100. Even with the decline on Friday, we're still above the 20-period moving average. So everything is still showing some improvements here. Then some rate of change charts. I use these for information. This is Friday's close, and then we go back 250 periods. It's long term. We're just kind of chopping along sideways recently. This is that same chart, but it goes all the way back to 1980, showing that we're above 0 and just kind of chopping sideways currently. With each video and course, members learn to implement the consensus approach, a unique analytical method. Unlike relying on a few indicators that eventually fail, this approach overcomes analysis paralysis by using the weight of the evidence to draw conclusions. Developed over decades across all market conditions, explore the SPX investing program and start with a 30-day free trial. Then we look at bonds, and we just want to keep an eye on the relationship between bonds because we can get some clues as to what is being anticipated by the market as far as inflation. This is the cash to 3 to 7 year bond ratio. When this is really going up, that means there's uncertainty about interest rates and inflation. Well, we're going sideways right now, so there's really no concerns according to this chart. Then we use that same approach and we look at TIPS, which are Treasury inflation protected securities, which do adjust for inflation, and usually they're shorter term, and we do a ratio of 3 to 7 year bonds. This ratio is actually declining. If this was going up, the market would be more concerned about inflation worries. Then we look further out with TIPS to 7 to 10 years, also just kind of chopping around, going sideways. We went up there for a little while, but now we've been coming back down. This suggests that the market's not really worried about inflation. And we look at the S&P on top, which is in red, and then the long-term bond based on price, which is in blue. And we can see that the longer-term correlation is still continuing to weaken, and we're pretty much neutral with the short-term correlation. Not really getting any insight here. We use that same idea. Instead of looking at the S&P, we look at the QQQs to the long-term bond and having a slight tendency to go in opposite directions of each other. And we keep an eye on the 2-year Treasury yield, that's shorter term. And this is more positive as we're seeing a series of lower highs and not really much lower lows, kinda in here, but we're seeing interest rates generally coming down, which is more positive for the S&P. Then I don't have the 10 to the 2-year in this particular video because it's normal. But there was one day this past week where we went back to being inverted when we look at the 10-year to the 3-month yield curve. We're back a little bit above zero right now, but this is not normal for this to happen. But we've been chopping above and below zero now for a lot of 2025. And we look at the Eurozone and then compare it to American bonds. This just shows how European stocks are outperforming. And then we have a number of different studies here. These are the percent of stocks above their 200-day simple moving average. And we use this like an oscillator. If we go above the green line or below the red line, well, we're far from that right now. But we are above 50, and so that is positive. And then we use that same idea with those stocks above their 50-period moving average. Even though we declined on Friday, we're still above 50, and we're not giving any kind of an extreme positive or negative reading here. We look at the mid caps, which are just barely above 50 right now. They had been improving. And we had small caps, which are dropping back below 50. So they're looking a little more negative. Then we keep an eye on the SPY, which is the ETF for the S&P 500, and then staples, which is more defensive, toilet paper and toothpaste. Earlier on, we were seeing a real breakdown similar to what we saw at the end of 2021 before we went into a cyclical bear market. Well, we were seeing that, and we were seeing a real breakdown here, but then we hit the lows back in April, and this ratio has really been improving, and we're above the rainbow for right now. So this is still holding up for the time being, but we still look at this chart every day to see if things start to break down. What was interesting about this is we hit a top with this ratio and started to come down in late 2021. We actually set the all-time high at that point with the S&P early in 2022. So this gave us a little bit of heads up that something was not looking right. And that's why we were watching this chart. But now it seems like things are trying to normalize and turn more positive. So thank you. I really hope you found this helpful. I hope you're having a wonderful weekend, and I will talk to you in the next video.